If you don't have any questions, we'll start. One thing, yesterday night I uploaded 2 more handouts. Sorry about that. I forgot to upload it during the week. We may use the futures 2 handout today. So we will continue with the futures today as well. So last week we discussed about futures. What's the futures? What's the futures contract? It is an agreement to buy or sell an underlying asset or instrument on a future date at a pre-agreed price. So what is the date that you are going to settle the transaction, and what is the price quantity agreed today whenever you enter into the transaction. So that's the basic. But then what's the difference between a forward and a futures?
Futures are standardized.
Futures are standardized and traded on exchanges. Not necessarily stock exchanges. That it can be just a futures exchange, or not only stocks. The other thing is, futures are traded on exchange. Forwards in which market? Forwards between the counterparties. That means, what's the word that we use?
Over the counter, right?
Over the counter market, yes. So the futures are exchange traded product, and forwards are over the counter markets. So what is the risk in over the counter?
Counterparty risk.
Counterpart over the counter markets, we exposed to the counterparty risk. Those are the major differences in futures and forwards. There are another pros and cons. So that we discussed those things last week. Underlying assets, that can be almost anything. And last week we saw how different futures contracts specification differ from one underlying to another underlying. Depending on the underlying asset, the terms of the contract may vary. And whenever we refer to a futures contract, we generally refer to a month. We call it a delivery month or the expiry month. Not each and every contract are traded on with delivery in every month. There are different months where you can deliver the futures, or expiry falls in. So therefore you cannot select your own expiry or the maturity. So likewise, some of the contracts maybe expires on March, May, July, September, December, or something like that. Or there may be some contracts, there are maturities in or expiry in every month. Some are on quarterly basis, things like that. Then we discuss about what are the consequences of standardization. What does it mean by same contract? A contract to be the same, that means the underlying, the exchange where you trade that futures, the exchange should be the same, underlying should be the same. and all the specifications should be the same. So in a given exchange, a given product is considered as the same futures contract. So if you buy and sell the same futures contract or sell and buy the same futures contract, we call it close out, and you don't have any exposure to the market, no obligation towards the market or the other parties. Indeed, no obligation towards the exchange or your broker. Then we discussed about minimum price fluctuation or the tick size. What does it mean by tick size? What is the tick size?
The minimum amount the price can change.
Yes, that's the minimum amount by that the price can change. So you cannot have or price cannot change by any amount. There's a minimum amount, and the price can change only by multiples of that minimum amount. Then the tick value is what is the tick value? If the price change by that tick size, what would be the change in dollar value of a single one contract? Yes. What is the dollar value of a one contract if the price changes by the tick size, minimum price fluctuations? So whenever you know those things, it is easy to calculate the profit and losses. You don't need to worry about the underlying or whatever. What you need, what is the number of ticks the market has moved, what is the value of a tick, and what is the number of contracts that you have bought or sold. Then whether it's a profit or a loss depends on whether ticks moved up or down, and whether you have bought or sold the contract. So you can factor that one here. If you use this or calculate number of ticks moved from the current price minus the board price, if it is a positive, then for a buyer it's a profit. If it is negative, for the buyer is a loss. But other way around, if you are a seller, you can do that way also, but not necessary to do that. You know, if you buy something, if price goes up, then you make a profit. If price goes down, you make a loss. If you sell something, price goes up, you lose. Price goes down, you make a profit. So you can use your common sense to get that. So we did few examples of how to calculate profit and loss. So today we are going to discuss from this point of and onwards what is the profit loss profile for a futures contract on the expiry date. That means the last date of the last trading date. What is the profit or loss, and how does it change with the price of the cash price or the spot price of the underlying transaction. So for a long futures contract, what does it mean by long?
You're expecting to
Overbought.
buy.
You have already bought a futures contract. Long futures means you have already bought a futures contract. What does it mean? You have agreed to buy the underlying on a future date. You have not bought the underlying, but you have agreed to buy that. So that's the long futures contract. So how do you calculate the profit on the expiry date? What is the spot rate on the expiry date minus the futures price that you agreed? That is the F is the, this is the agreed price. This is the agreed price. This is the agreed price. This is the spot price on the expiry date. So the difference, if it is positive, it's a profit. If it is negative, it's a loss. That means this is the price that you agreed to purchase the underlying. This is the spot price. If the spot price is higher than what you agreed, then it's a profit. If the spot price is lower than the price that you agreed, it's a loss. So what would happen if spot price increased by $1 or 1 rupee? Spot price increased by one unit. What would happen to the profit? Now F is fixed because that's the agreed price. Now on the expiry date, spot price is changes. Oh, ultimately it will be fixed. But from the agreed price, if it is deviate by $1, what is the profit?
$1 profit.
$1 profit. If it is deviate by $2, that means $2 profit. So that means if it's increased by $1, profit increased by the same amount. So price increase, profit also increased. So we can put this relationship into a diagram, that is we call the profit or the loss profile. We'll come to that. Assume you purchase a September delivery light crude oil, that means WTI futures contract at a price of 97.72, and you hold it until maturity. That means you purchase it today and hold it until September, whatever the last trade day. What would be the shape of the profit depending on the spot price of a crude oil barrel as at the expiry date? So remember this one. This is the price of the underlying at expiry. As at the expiry date, what is the price? We can put simply it as spot rate is, and the y-axis shows your profit. How could it be changed? So if the price is at 97.72, what would happen? Spot price is 97.72. Your futures, you bought the futures at 97.72. Spot price also 97.72 on the expiry date. What is your profit? Go back to this. What is your profit?
No profit or loss.
No profit or loss. It will be 0. Assuming there's no other transaction cost. Huh? Okay, then what would happen if it increased to 98.72? If price increased to 98.72, what is the profit? Assume here. What's the profit? It should be $1. So for each dollar the price increases, profit increases by the same amount. So therefore profit and the spot rate at the expiry date has a linear relationship. It's 1 to 1. Whatever the amount the price changes, profit changes by the same amount. So therefore it is if you plot it, it will be a straight line like this. But if the price goes below the futures price that you agreed, it will be a loss. Still same, 1 to 1. So this is the payoff or the profit profile for the in a futures contract. Payoff and a profit both are the same. So this is the diagram, payoff diagram. You can see it's a linear and it increases with the spot price. And where you get zero profit, this is the break-even point. What is this point? When spot price equals to the futures price that you agreed. Clear? Is it clear? Or you have any questions?
Shanda, when the price increases, the profit percentage that increase is going to be the equal point, no? Not the exact profit that we get, no?
When price increases?
The profit percentage increase that we are going to get is what's equal, no?
Not the percentage, just the absolute figure.
Absolute figure.
Yes, that's why $1 increase, you get a $1 profit. Profit percentage would be $1 divided by 97.72.
Yeah.
But here we are referring to the absolute figure. Clear? Is it clear?
Yeah.
Even you put it into a percentage form, profit or the rate of return, it should be the same. If the profit increases linearly and this is constant, only the figures would change, but the shape would be the same. Anything else? Then can you think about if it is a short futures, what would be the shape of the diagram?
It's other way around.
What do you mean by other way around?
Downward sloping.
Downward sloping, because when you are short, you make a profit when the price goes down. You make a loss when price goes up. So therefore, what is the maximum profit that you can get when the price is 0? So it will be a line. When you are short, it will be a line, straight line like this. True. Okay, we'll come to that, however. So in this, what is the maximum profit that you can earn?
There's no maximum profit, right?
Unlimited, sir.
What do you mean no maximum profit? There's a difference, huh? No maximum profit means there's no maximum.
Okay.
You don't get anything.
So it is unlimited, like.
Yes, there's no limit. That's what you meant, I think. Yes, there's no limit. Whatever the price increase, you get everything. So if the price goes to infinity, you get infinite profit. So there's no limit on that. But what is the maximum loss that you can incur?
That is 97.72.
That is 97.72. So that is the maximum loss. It should be same as the price that you agreed. Why? At this point, spot price is 0. So whatever you bought, there's no value. Then the price that you agree, you lose it completely. So this is indeed minus 97.72, this point. So that's the maximum loss. So, and the break-even point occurs when the spot price equals to the futures price. That's the break-even point. At that point, you don't incur any loss or a profit. So it's summarized here. Maximum loss limited to. Yes.
Sometimes that prices can be minus also, no? That oil prices recently like this can be.
Oil prices?
Means minus levels, no? That means when you store, they are paying.
Yes, some instances, yes, that can happen, but not the price goes to minus. Interest rate that can be go to negative, but prices won't go negative. Price would be 0. However, if it goes to minus, what does it mean? Then there's no limit again. If it can go to minus infinity, your loss would be infinity again. You make an infinite loss, but practically it won't happen. You can't go price below price that cannot go below 0. So what happened in oil very recently? It's not the prices went negative. It's the futures. If you want to buy futures, the seller would pay you. That's what happened. This futures price becomes negative, not the price itself. You will see whether it's possible to have. Okay. Anything?
Okay.
So maximum profit is there's no limit, unlimited. Maximum loss bound by the your purchase price or pre-agreed futures price. In the short futures, the story is, as you said, it's other way around. Profit is calculated, remember, futures minus spot. In a long future, spot minus forward. In a short, forward minus spot. Or you can use the same equation and put a minus sign at the front. Then you get it. So what is F here again? What is the price that you agree? What is S here? What is the spot price prevail on the expiry date? That difference is your profit if you are short a future. So I think you understood it. So therefore, we can go to the next slide. So this is the payoff diagram. When the price goes to 0, you make the maximum profit. What is the maximum profit here? What should be the figure here?
97.70.
97.72. Again, break even occurs at when S equals F. Whenever the spot price on the expiry date is higher than 97.72, your purchase price, it will be a loss. So you might see here, there's no difference whether you buy the asset and keep it or whether you buy a future. Or you sell the asset and wait. Still, the output is the same. So it's a linear relationship. Profit or loss would change one-to-one basis with the change in the price of the underlying. But remember, this linear relationship prevails only at the expiry. Depending on the price at the expiry, your profit or loss would be decided. But before the expiry, it's not a linear relationship due to the time value concept. So because the price that you agreed is a futures price, what you agreed to pay on a future date. But spot date, before the maturity spot date, a spot price would be the price that you pay today. So there's a time difference. Therefore, you have to think about the time value of money. Then the relationship won't become a linear relationship. So, however, remember, we are not going to discuss that one here. On the expiry date, this is the payoff diagram for a short futures contract. The previous one is a payoff for a long futures contract. So in the short, again, maximum profit is limited, maximum loss in the short futures, maximum profit is limited, maximum loss. What is the maximum loss?
It's unlimited, right?
Again, unlimited. There's no limit for the loss. So maximum profit is limited to the pre-agreed futures price, whatever the price that we bought, and maximum loss is unlimited. There's no limit. Whatever the price goes up, whatever the amount, you make a loss. Okay. Buying a futures contract or selling a futures contract, does it carry the same risk? Buying a futures contract and selling a futures contract, does it carry the same risk?
No.
Yes or no?
No.
No. Why?
Because if I'm selling a futures contract now, from at today's point, my whatever profit or loss be realized, no?
No.
Because once I sell it, afterwards I'll not have an ownership on top of it.
No, but if you that because of you, that happens only if you have bought it already. If you don't have,
And then buy and
then you have to buy.
first buy.
Short futures means you didn't have anything, you sell a futures contract. You agree to sell something on a future date. Okay, if I go back, the long futures and short futures carry the same risk. Do they? Is it the same risk? Long or short futures?
That won't be the same risk, right? Because if you're short, your maximum loss is unlimited, and if you're long, your maximum profit is unlimited.
Exactly. Yes. Just by looking at these, you can realize that your maximum loss is unlimited in a short future. So you take a huge risk here, but profit is limited. Whereas in a long, your profit is unlimited, loss is limited. Profit is unlimited, loss is limited. So therefore, this is less riskier than short futures. It is simple as it is. It's not no need to think a lot. Just by looking at your profit opportunity and the loss, you can decide it. So having a short futures is a riskier strategy. Remember that. So basically, if you are long, that means you have bought a futures contract. Price of the asset increases or go up to make profit. This is very simple concept. If you have bought anything, price of it increases, you make a profit. The opposite is true when you have a short futures. That means you have sold a futures contract. Then you make a profit only if price goes down. Clear? This is same as for any other asset. If you buy it, price increases, you make a profit. You sell something, price goes down, you make a profit. The same. Yes.
Is not when you sell something, price goes down, right? Because when I expect to sell it in a future date, so that is where my opportunity comes, right? Because I have not already sold this, right?
But you have already sold the futures.
No, so this is not a writing of a short, right? This is a purchase of a short, right?
There's no something. You just short the futures contract. That means you agree to sell the underlying asset on a future date.
So there's like
basically you have sold the futures contract. Forget about the underlying. You have sold the futures contract. You have already sold.
So I have sold the contract. So
Yes.
then I have sold a contract to sell futures. So that is I'm going to take delivery, right? That's like two things, right?
No. When you short a contract, you are going to deliver the underlying.
So is it like so there's a not like a option, right? So in option
Not
you have
like
a writer and
this is not like option.
okay. So this is
Or
just when you're short, you're selling.
yes,
When you're long, you're buying.
yes.
Okay. Cool.
And the main concept here is a long future, short future is basically now itself I'm going for an agreement on a future state. So at that
Yes.
point, I can't go. I mean, at that point, whatever it is, whatever I've agreed today only will occur. So that is where the
Yes.
profit and loss comes into play.
Yes. Whatever the price, futures price that you agreed, that's the
Yeah.
price. The price is locked.
Price is locked. So based on that graph, if it goes up and down, my profit or loss position comes into play, no?
Yes, that depends on the spot rate prevail at the time of expiry.
Time of expiry. And it will be a comparison between the rate that I have agreed now and the rate that
prevail at the market on the expiry date.
And that graph
drives your profit or loss. Yes.
Yeah. And that graph elaborates that easily, no?
Yes. This graphs, yes, that's why I mentioned. Remember, this price is the price of the underlying asset on the expiry date. So depending on what is the price prevail, you can derive what is your profit. It doesn't mean that on the expiry date the price can be everywhere, but there can be a single point. If this is the point, this is your profit. If this is the point, this is your loss. Remember, whenever you enter into a long position or a short position on a futures, you have the obligation.
Yeah, we have to complete the contract at that day.
Yes, you have to deliver.
Yeah.
Or receive that, or take it, or give it.
So, so when you say you go on short, that means you sell a contract, you purchase a contract to sell the asset in the future time.
No, you don't consider it as, yes, in a way we don't call it purchase a contract to sell. We call it straight away short the futures contract. That means you agreed to sell it on a future date.
Okay.
Basically, what has happened, you have say forward. You buy forward, you sell forward.
Okay.
When you say you sell a forward contract, what does it mean? You enter into an agreement to sell the underlying on a future date. You don't say you buy a forward to sell. It's
Okay,
not,
so
we don't use that.
Okay, so exchange is not the person who is selling it. Is that?
No, some other party.
All right.
Yes.
There is no logic of having an inventory or anything. No, it's just a contract basically.
Yes. This is just futures is just a contract. You may have to have an inventory of futures contracts, not the underlying asset. But you have to maintain what is your position in futures contract, whether you long or short.
Yeah, and also what happens is, as we said, on the day of the future, it's basically a monetary transaction.
That depends. That depends on the contract specific.
Yeah. If
it
we
is
just
a physical delivery, you have to either you have to take the physically that goods, or if you're a buyer, if you are a seller, you have to deliver that goods. That depends on the specification of the contract.
Yeah. So what happens is, in other words, if it is goods, it will be more clear, because on the day of maturity, I will have to buy and only sell it back. So there the profit or loss comes into play. No.
Yes. No. Even you say okay, we'll go back to this. What you have agreed here, agreed to buy oil barrel by paying $97.72 in September. Assume you hold it
till maturity.
And on the expiry date or whatever, you hold it until maturity. So the contract expires. Now you have an obligation to pay $97.72 to the exchange and collect an oil barrel of oil from their warehouse.
Yeah.
That's the agreement here. How do you feel if the price of a oil barrel is $100 as of that date?
It's a profit, because
profit. So you get something valued or worth more than what you pay.
Exactly.
That difference is your profit. Whether you sell it or you keep it or you use for your whatever the for manufacturing or whatever, you can use that oil.
Yeah. Yeah.
No need to sell, but still you make a gain. The difference between 100 and 97.72. That is the profit. But on that day, if the price was 95, you could have bought it at 95, but now you are paying 97.72.
Overvalued.
Overvalued. That's a loss for you. Clear now?
Yes, Mishan. Thank you.
Okay, great. Anything else? So yes, better you make clear how this work mechanism. In the futures, it's almost like a forward. You don't buy or sell anything today. You just enter into agreement to buy or sell. If you enter into buy something, we call it a long future. If you enter into a contract to sell the underlying, we call it as a short future. Okay, anything else? If not, shall we move forward? So this is what we discuss. When you buy a futures contract or sell a futures contract, you get the exposure to the market. Because once you fix the price, until maturity, market price may change. Underlying price of the underlying asset changes, and whether you make a profit or loss depend on the price of the underlying asset prevail on the expiry date. Not only on the expiry date, even if you want to sell it or close your position before maturity, the spot price on that date matters because the futures price will depend on that spot price. So says you buy a September contract, this September contract at 97.72 in July. In August, you decide to sell it. So you have to sell it at the prevailing price of the futures contract in August. It can be more than 97.72 or it can be less than 97.72. That price will depend on the spot price as well. If the spot price has gone up, most probably futures price also might have gone up. If the spot price has gone down, futures price may also follow. We'll see that how the spot relationship between spot and futures price work, but there's a relationship. Basically, spot price drives the futures price. So therefore, you exposed to the market risk, whether you have bought or sold. That means whether you have a long futures or a short futures, whatever it is, you get the exposure to market risk. But this risk is high if you are short a future. That means you have sold a futures contract, because if price increases, your loss increases without any limit. Clear?
Yes, sir.
Yes.
So in between the contract period, if we want to terminate the contract, at that point of time also we can draw the payoff diagram, right?
Yes. That, but you can draw it, but that depends on the it may not be a linear relationship, because because
So
that
the
profit
spot price.
then you cannot calculate. use this equation to calculate the
Yeah,
profit
the
or
profit and loss may be the different. No?
yes, in that case, it would be F naught. What does it mean, F naught? This is what is the price that you agreed minus price of the same future at the time that you sell. Sorry, it should be other way around. No, this is a short. This is correct. Yes. This is linear. Relationship between F naught and Ft is linear, but Ft depends on S. This is not linear. If spot price increased by 1 unit, futures price may or may not be increased by 1 unit. So therefore, relationship between spot price and futures price, the difference at any point of time, it is not linear. Is it clear?
Yes, sir. So this is comes under off balance sheet event, right?
This is a
All these futures.
derivative. This is a derivative, but now they are not going to use this concept no longer. No? I'm not sure about accounting treatment.
But the forward also comes under off balance sheet, I think.
Not necessarily.
Yes. If it's a 1 week.
If you use hedge accounting, that means to hedge your existing position. That's one way of doing the accounting. If you don't use hedge accounting, or if this is trading purpose, if you do a futures contract for futures for trading purposes, then it would come under trading book. Then you have to do mark to market and take that difference into profit and loss. So therefore, it not necessarily comes on as off balance sheet items. That depends.
Okay, sir. Okay.
I'm not very much sure about accounting treatment. That's what I know. Anything else? So the other risk are counterparty risk. With whom you trade and what is the risk. As we mentioned, the futures are traded on an exchange, but the buyers and sellers may be any party. But these trades, you cannot go directly to the exchange and do a trade. You need a broker there or member who is having a membership in the exchange. You do the trade through that broker. So therefore, there are few parties involved in the transaction. In the middle, exchange is there. Then there will be a broker. One, broker, two. This is buyer. This is seller. So buyer will contact his broker, seller will contact his broker. They will agree it on the exchange, then what happens? Indeed, even though the trade is between these two parties, initially agreed between these two parties, even on the exchange between these two parties, broker of the buyer and the broker of the seller. Once they report it to the exchange, this trade is broken into two. Exchange becomes the seller to the buyer. Indeed, there's a clearing house of the exchange. That party becomes the seller to the buyer and buyer to the seller. That's what happened. So it will break into two transactions between the broker and the exchange, broker and the exchange. That's what happened. We call this process as novation. Transaction between two parties, break it into two, and the exchange comes into the middle. Exchange becomes a party to each trade. So broker will settle the transaction with the exchange. Buyer's broker will settle the transaction with the exchange. Buyer won't pay anything to the seller. Buyer will pay only to the exchange. Seller will deliver its goods to the exchange. Buyer, exchange will pay to the seller. So even one party goes out, bankrupt or defaulted, exchange will settle it to the other party. Either way, either seller defaulted or buyer defaulted, the exchange will honor the contract to the other remaining party. So that division of contract between two parties as two trades between one party and the exchange, we call it as novation. So that's how it works. So therefore, counterparty risk is minimum.
So that's why you need a margin, right?
Yes, true. But then doing that, exchange take a huge risk. To minimize that, they ask for margin. But the thing is, as a buyer, if you are not a member of the exchange, you cannot directly trade with the exchange or settle transaction with exchange. You go through the broker. Then the exchange take the risk of the broker.
So when broker, like,
You take the risk of the broker. Yes.
so broker might have to keep separate margins with the exchange, right? For this.
Yes, yes. There's a separate mechanism to get a membership of the exchange. You have to pay. You have to buy that seat and to get that membership.
Okay.
Beyond that, for each trade, broker has to keep the margin depending on the margin requirement for the particular contract.
So
Depending on different contracts, type of the contract, market volatility of the underlying price, margin requirement may vary. However, broker has to keep that margin with the exchange. So then broker won't take that risk. Broker will charge you. So therefore, you have to keep the margin with the broker. Broker will pass it to the exchange. That's what practically happens. So therefore, but however, there's a small risk that your broker may go bankrupt or go out of the picture. Then there's a small risk. That's the only risk exists. Broker and the client, and the broker and the clearing house. That's why it says futures are almost having zero credit risk. Very minimum credit risk. These brokers are bound to follow the rules and regulations issued by the exchange. They monitor them as well. So that's the other risk that we face in futures contracts: market risk and counterparty risk. Counterparty risk is very minimal, but in a forward contract, there's no exchange, even there's no brokers, even though they have a broker to meet the buyer and seller. Once the transaction is done, broker has nothing to do with it. Buyer and seller face each other directly. If seller goes out, buyer makes the loss. If buyer goes out, seller makes the loss. Clear?
So, the one broker can be with broker of both seller and buyer?
Yes, that can be. Because this broker might receive buy and sell orders, many buy and sell orders. So the broker can match those. That can happen. But it's a specific case. This is the general case that we consider.
So in case of that exchange, how they are cover up that their loss in case of seller or buyer bankrupt?
There's a procedure to be followed. So basically, to become a member of this exchange, we call them members, and there are different type of members. You have to pay something to the exchange. It's like buying a license sort of things. You have to buy that. Then you have to keep a deposit sort of thing. Then for each trade, you have to keep the margin. There's a way of doing that waterfall method. I'm not going to discuss that.
Sir, like, can individual brokers match their orders within like their clients without going to the exchange? Is it?
No, they have to report it to the exchange ultimately.
Okay.
Otherwise,
There's no.
Otherwise, they take the risk. Broker takes the risk.
Yeah.
Broker does not want to take that risk because the position is square. There's a buyer, there's a seller. So once you report to the exchange, broker's position is net off.
But even though broker wants to take that risk, it should not be like.
It should not be. Yes. He can. Yes. Anything else? The other one is liquidity risk. What is liquidity risk? Here we are talking about which liquidity risk? Basically, we worry about trading. What does it mean? What does it mean, trading liquidity? We can. Sorry?
Ability to buy or sell any.
Yes. So, ability to buy or sell any asset without having a adverse impact to the price. When you try to buy, if the price goes up, it's not good for you. When you try to sell, if price goes down, that's not good for you. So without having that impact at the current market price, if you can buy or sell any amount of the asset, that is a very liquid market. So in the futures market, the liquidity is very high. So therefore the liquidity risk is low. You can buy or sell any amount of most of these futures contract, but however that may vary depending on the futures contract. Different futures contracts may have different liquidity, but generally most of futures contracts are liquid. But when compared to forwards, it's more liquid. In forwards, there's no liquidity indeed, because you cannot sell your forward contract to someone else. You have to keep it until maturity and settle the transaction. There's no way that you can sell it to someone else, the forward contracts. But futures contracts, you can buy or sell at any time, so the liquidity is high.
So when you say like you have a lot of liquidity there, is that because exchange is agreeing to give you the contracts, or there are like so many parties involved?
No, not the exchange. Exchange would take the position.
Okay, so
There should be a buyer or seller on the other side.
Okay.
But since the product is standardized, there can be many buyers and sellers.
Okay. So the exchange won't take a position.
Exchange won't take the position. Always exchange position is 0.
Okay. Thanks.
So I think from this and the next few slides about basically forward contracts, as we discussed at the beginning, also forwards and futures are the same thing, very similar to futures. OTC market contracts are customized, as we discussed. On forward transactions, we can customize the transaction. What is the amount that we need? What is the value date or the settlement date that we need? That can be agreed between two parties, not like a futures. That's the one advantage of having forwards. So I think we discussed all those things. No need to go again and again. Futures contracts, we do mark to market every day, and you, based on that mark to market, you keep the margin. You change your margin requirement. But forwards, generally, we don't do mark to market daily. But now the trend is, even for forwards, both parties are going to do mark to market and exchange the margin between two parties. I'm not referring to individual. If you do a transaction with an individual, you take the margin, but this is even for forwards. But here we are referring to wholesale market among banks or corporate clients, especially among banks or financial institutions. They don't do mark to market daily, but nowadays the trend is they do mark to market, but it may not be daily, depending on the tenor of the forward contract, maybe weekly or monthly. They do mark to market and exchange the margin between two parties, but it's not mandatory yet in anywhere. And the transaction is settled on the delivery date. Both parties have to wait until the delivery date and settle the transaction. On a futures transaction, it's not like that. Anytime you can enter into the opposite trade and close out your positions. Forwards and futures both are derivatives, so price based on the underlying assets.
So what is the interval mark to market?
Mark to market means what is your agreed price, what is the current price, that difference is, so then you value your contract based on that. that difference becomes a profit or a loss. One party make a loss, other party makes a loss.
Even without doing the trading, do we have to do that?
Sorry?
Even without doing the trading, we have to do that. So
Yes. So forwards, even though we don't do trading, you can't do the trade the forward contract, but to minimize the risk of the counterparty, now the tendency is to do that. You don't wait until the maturity date and deliver it at once.
So it is done to minimize the market risk.
No, it is, you can't minimize market risk through margin. It is to minimize the credit risk of the counterparty risk, to minimize this counterparty risk.
How that have minimized the counterparty risk?
Because whatever the gain, if you make the gain, the other party is losing the same amount, that party pays you that difference. So even the counterparty goes bankrupt, you have got your gain.
But the counterparty risk still remains. It is only calculating the accounting purpose.
No, since the counterparty has paid you whatever your gain, now you don't want to worry about the counterparty. Say you agreed to buy something at 100. Now the price is 101. So you make a $1 or 1 rupee gain. If that counterparty pays you today that 1 rupee, even though the maturity of the forward contract is in 3 months, then you have got your profit from 100 to 101.
That means it is still before the maturity, the contract is fixed.
Sorry, I cannot hear you properly.
That means contract is settled before the maturity.
No. So next day, maybe you are paying back that, because if it goes other way around, it may be you are paying it back, and you settle only the mark-to-market gain. But in a forward, on the maturity date, you have to settle it full. Once you net the mark-to-market gain or loss and settle it in full. In a way, you set during the period you settle it partially.
So these mark-to-market gain or losses are settled between the margin amounts with the exchange. Is that how it works, or do you have to like?
In futures, mark-to-market difference is settled through your margin account.
Okay,
you maintain the margin account with the broker. Practically, what happens, but broker may maintain it with the exchange. So practically, yes. Say not practically. We can think it as that way.
Okay. And when you want to exit a futures position, right? Do you have to take the opposite position, or can you just trade that take contract?
That means, yes. What do you mean by you take the opposite position means?
I mean, you have to purchase another different.
Yes. Say if you have sold already, what you have to do? Buy another futures contract on the same.
Can't you sell the existing contract to someone else without taking a different position?
There's no such thing. Once you enter into a transaction to sell, that means you already bought one and now sold one. That will be set off. Yes. You don't maintain any open position with the exchange.
So
once you do that,
once I purchase a contract, that is not tradable. Is
it's
that
it's tradable. That's why you said you sell futures.
okay? So
Then
can I sell that contract to someone else to come out from my position, or do I have to purchase another opposite
no,
contract?
as I mentioned, there's no purchase of opposite.
Okay.
You buy a futures and you sell a futures, then it's
Just
like
as it goes.
what you sell what you bought.
Okay. Okay. Right. Yeah, makes sense.
So in the exchange, say like, okay, if you buy a bond,
Yeah.
government bond in Sri Lankan market, how do you sell it? You just say, I sell this. So then whatever the bonds registered under your name, they will take it out, take it out from that and pass the ownership to the other party. So same
thing applies.
same thing happens. That's why we call those are fungible, even though you cannot. Those are tangible, but the same thing, unique product that you are buying and selling. Same underlying, same expiry. That means the same contract. So whatever you bought, you sold the same thing. If you sell only part, it will set off. Net, and whatever the net balance will be shown in your as your position. Say you bought 100 contracts and you sold 100 contracts and sold 150 contracts. From a long position of 100, you will move to short of 50.
Yeah. Thank you, sir.
So, and this mark to market, it doesn't necessarily mean that you pay the margin. You just calculate the mark to market and see whether you are making money or losing money. But in futures, you do the mark to market and depending on that gain or loss, you keep the margin or you receive the margin. The same thing can be done on forwards as well. But still, it's not a mandatory thing, or not each and every party is doing that. Is it clear?
So excuse me,
Yeah.
mark to market means calculating the profit, something similar to that? Or?
No, once you do the mark to market, you will get the profit or loss, but it's value in your position to the current market price. Say you bought something by paying 100. If today's current price is 101, mark to market value of your position is 101. So you bought it 100. Current market price is 101. Value is 101 today. So the $1 or 1 rupee difference is your profit. If you bought it at 100, current market price is 95. You value your position as at today at 95. The difference, 5 rupees, is loss. When you do mark to market, value of your position will change depending on the market price to reflect the difference between the price that you paid or sold or received, depending on whether you buy or sold it, bought or sold it. That difference goes to P&L.
Okay, sir. Thank you.
So what you do, you value all your positions to the market price. So indeed, what happened, what should happen, say in accounting, again, you can do it in different ways. Say you bought it at 100. Next day price is 101. You change your books. Assume this is a bond. You have now, as at today, your book will show you have bonds worth of 101. But yesterday it was only 100. So now there's a 1 rupee difference. It should be reflected somewhere. So that 1 rupee will goes to the P&L. Then next day this becomes 100.5. Now what would happen? Minus 0.5 from yesterday's to today goes to the P&L. So net would be from here to here. It would be 0.5. So when you do that, either you can reverse this $1 profit and again account for 0.5 comparing these two prices, or you just post mark-to-market gains and losses every day to your P&L. So net figure would be reflected. Either way you can do that. So if the next day again it goes to 102, this is the market price. So your value of your position would be 102 now. So what is the gain here? 1 day gain is 1.5. This is the one day gain. Once you post it here, you can see when you accumulate this figure, you still get 2. Same as between 100 and 102. So this is the market value, mark to market value of your position. This is the P&L figure. Is it clear?
Yes, sir, it's clear.
So in futures, it is mandatory to market.
Sorry?
In futures, for futures, it is mandatory to market.
Yes. Based on the mark to market value, your margin balances changes.
For the bonds, it's not mandatory now, sir?
No.
When we talk about the bonds, that is opportunity loss or opportunity profit, no? Because you are getting normal coupon payments and whatever maturity values, but depending on the market, you will get a gain or loss.
Yes, it's not opportunity. Indeed, it's a gain or loss.
Okay.
For bonds,
if it's a bond, what does it mean? You bought it at 100. Now the value is 102, but you do this only if the bond is held in the trading portfolio.
Yes.
If you held it in the held to maturity portfolio, you don't do the mark to market based on the accounting standards. If it is held in the trading portfolio only, you do the mark to market. Whatever the difference goes to P&L. So say next day you sold it, you sell this bond at 103. From 102 to 103, 1 rupee or $1 profit will be realized. And with this mark to market accumulated figure, all $3 will be reflected in the P&L.
P&L under trading income, no, sir?
Trading account, yes.
Yes.
But in a trading book, if you keep this until maturity, whatever the interest income will be realized on the coupon dates, and there won't be any profit and loss.
Yes.
Because on the maturity date you get 100. But if there's any difference between the purchase or the price that you pay to purchase it and what you get on the maturity, that will be reflected in the P&L. But you are not supposed to keep it until maturity if you keep it in the credit book.
Yes.
So the futures also same. Futures you have to do mark to market, at least for the requirement of the exchange. You do the mark to market. If you make a loss, a profit, you can withdraw from your margin account. If you make a loss, you have to top up your margin account. If you're really interested, we can have a separate session on how this margin worked, but we was initially thinking not to do that. Shall we move forward?
Sir, excuse me, only trading book does this mark to market, and
that depends.
AFS, what about AFS?
AFS also, yes. AFS. Yes, if as I mentioned, I'm not very sure about accounting standards. Yes, even now it's a different now. What do they call FEOIC and FEPTL?
OCI, no?
Yeah, yes. So, however, depending on that, you have to do that. I think OIC, OCI, other comprehensive income. That comes from that's for the AFS, no? Fair value profit and loss is the trading book definition. And through other comprehensive income, I think even for that one you have to do mark to market. That's accounting perspective. But here I'm not talking about this mark to market requirement from the accounting perspective. This is from one way is risk management, and other one is operational perspective for futures. Futures are mark to market by the exchange, and depending on the mark to market gain or loss, your margin balances changes. Either you have to top up the margin if you make a loss, if you make a gain. If you want, you can withdraw or you can keep it there. But practically what would happen, you just keep it there to minimize the operational risk, or otherwise, and the operational cost. Otherwise, you have to send SWIFT messages here every day to take fund out and again put that back. So generally you don't do that, because even for the margin account, you get the interest. So in generally for forwards, you don't do mark to market. But now the trend is there, moving towards that. Even the OTC market parties agree to have a do mark to market, not very frequently, but regular intervals depending on the contract period, and exchange the margins. So that means that mark to market gain or loss. That is to minimize the counterparty risk. Accounting point of view, it's a completely different story. Depending on where you held this futures or forward contract, you have to treat it in that way. But still, I'm not sure whether futures can be held in sort of a held to maturity portfolio, because it's derivatives. Either you have to use hedge accounting or the other way. I think so.
that how this reduce the counterparties, how that means depending on market rate changes, that increase or decrease the risk, that's how that happens.
Because say you agree to buy it at 100, next day the market value is 101. Say counterparty bankrupt, what would happen? Now to buy the same forward contract, you have to pay 101. So you make a loss opportunity cost there, 1 rupees. So, but if that party has paid it back to you now you don't mind buying it with paying at 101 today, enter into the new forward contract with someone else. That's how you minimize the counterparty risk. So think like this: your agreed price is 100. After a few days, market price is 102. Or say on the settlement date, market price is 102. What would happen if the counterparty defaulted? You lose it.
But even if we mark to market, it's the same, no?
No, but because these two mark to market, and you have to use the margin. Whenever they do it, say by this time, at least at this point, you got this difference. You get on this date, if the counterparty goes out, at least up to this, whatever the mark to market gain you have collected.
So is there any regulator requirement
for forwards? Not yet.
Others it is there in 10%.
But it is encouraging now. That's what.
So I think if we mark to market only, we can take any decision on our position. I think we can buy or sell if it's loss.
No, that's again another thing. If so, for trading purpose, you have to do mark to market, and you can see whether it's a profit or loss. Then you can take the trading decision. But forwards, as I mentioned, you cannot trade forwards.
Yes, sir. Yeah, that's true.
In futures also, yes, mark to market you can use to calculate your profit or loss and trade. If you want to trade futures, depending on your P&L, you can take a decision. Anything else? Is it clear how this margining would reduce the counterparty risk?
Okay.
Okay. Anything else? So again, forwards, this is just few examples how these forwards work in physical market. That means where you have a physical good to buy or sell. In the cash market, it means like purely financial instruments which settles in cash. So in a physical market, forwards, an airline may enter into a forward contract to buy jet fuel using a forward contract to lock the price. Then say 3-month forward contract paying $101 per barrel. Then airline knows what is the cost of fuel in 3 months time. So they lock the price. Based on that, they can do other pricing, what is their fare and things like that. But there's a risk of doing that one as well. But however, on the maturity date, what this airline has to do, pay whatever the price and receive the number of barrels, because they need oil physical. That's why they go for the physical market. Or it's same story for a construction company. They want to buy steel. They can enter into a forward contract. Then on the maturity date, they will get necessary steel at the pre-agreed price. In the cash market, it is like maybe interest rate or foreign exchange. If you want to buy a foreign currency on a future date, you enter into a forward market. Today, on the expiry date, you pay whatever your currency amount, your selling currency amount, and you receive the currency that you bought the same amount. So that's the difference, physical market and cash market. Advantages of forwards, as I mentioned earlier, it's flexible. You can decide what is the size of the contract, what is the date, and whatever other terms and conditions, if both parties agree. But in the futures, you don't have that flexibility. Everything is specified. What you can agree, only the price. Once you select one contract, everything is specified. What you can do, agree the price. And the futures, the underlines are again given by the exchanges. So there may not be futures contracts for each and every underline. Say if you take dollar rupee transaction, we don't have a futures market. We don't have futures. So, but in forwards, if you need, you can enter into a forward contract if both parties agree. There's no restriction. And other thing is, forwards are available through most of the commercial banks. It's not necessarily be foreign exchange, even for other products. This is the truth. Forwards, you can enter into with a commercial bank if both parties are agreeing to the contract. So
in physical market and cash market, the difference is that physical market
in this context, physical market means one of the deliveries is a good. You deliver. Sorry?
Other is in currency.
Other in his currencies, yes. Either if it is a interest rate product, it may be only one currency, but you make a payment or receive the payment, that's it. But if it is a FX market, you exchange two currencies. But in the physical market, you exchange funds and a physical good.
Okay.
Because they are end users of this physical good. So they need it. The buyers mostly, they need it, so they buy it. So forwards and futures both are the same. We can use it to speculate or to hedge, and as we discuss in FX forwards, to explore the arbitrage opportunities. We'll discuss about this arbitrage, especially after we finish how to price futures. Then again we can discuss about how can we use this to explore the arbitrage opportunities. And later in risk management side, we'll discuss how can we use this to hedge your position and what does it mean. Anything else? So we are going to move into the pricing. How are we going to price the options? Sorry, futures. Any questions? If you don't have any questions, so okay, we'll take a break here because otherwise we'll have to take the break in the middle of the new topic. Better to take the break here. Is it okay? Or is it too early? So here, basically, we are going to discuss futures pricing and what does it mean by contango and backwardation, basis and basis risk, how to do arbitrage trade and hedging and basis risk. So these are the topics that we are going to discuss. I don't think we can cover all these today, but at least we'll try to finish pricing part today. So therefore, before we move into that, shall we take a break here?
Sure, sir.
And come back in 15 minutes.
Yeah, sure.
Okay, thanks. Okay, if not, we'll move forward. Futures pricing. So you have experience of pricing a forward, foreign exchange forward. You know that how to do that. We use that arbitrage free or no arbitrage concept in pricing the foreign exchange forward contract. The same concept is applicable here or is applied here. So the price of the future is derived from the price of the underlying asset. So what is the underlying asset of the futures price, futures contract? So the one of the input for the pricing is the price of the underlying asset, and the others are the net cost of holding. That means if you hold that asset for a period of time, what is the net cost that you incur? Those are the things that factored into the futures price. And again, I just want to highlight this, and I mentioned that same thing when we discuss about foreign exchange forward prices, forward price or the futures price. It is not an indication or it doesn't show the market perception of where would be the price of that underlying asset on a future date. So it's not the case. It doesn't give you a forecast or indication of the future price. That means price of the underlying asset on a future date. It doesn't imply. So as I mentioned, the price relationship we derived is based on the arbitrage, no arbitrage principle. So consider this simple case. Forget about what we don't care about what is the underlying asset here and what is the what is the underlying price. What is the underlying asset, we don't worry about here. Just think there's a futures contract, whatever it is, cash price, that means the spot price of the underlying asset in July, say today, it's 400. If you want to buy a futures, September futures, price is 417. And if you want to buy a December futures, the price is 433. You can see the both futures prices are higher than the spot price in this example. And the longer the time to expiry, higher the price. So this is an example only. So we'll see whether this is true everywhere and for each and every asset class or each and every market conditions, whether this relationship will hold or it may differ. We'll think about it, or we'll see that later. So for the time being, consider these things. What does it mean here indeed? So now we are in July. Assume you need this asset, whatever this asset, in September. You need this asset in September, not today. You don't want it today, but you need it in September. What you can do? What are the options available? Say if you need something September but not now, the market price as at today is 400. What are the options available?
You can buy today and store it.
Yes,
Or
you can buy today and keep it until September.
or you can buy September from the market.
And other thing is wait. Don't do anything today. Wait and buy in September. It's not necessarily you have to buy it today because you need it in September. You can wait until September, until the time you come to your real requirement. You can buy it, or else you can buy it today and keep it until September. Why do okay? What is what okay? Why do you go for the first option? Instead, go for the second option. What would be reason?
Opportunity cost.
Opportunity cost. What do you mean by opportunity cost?
In the sense now, if I lock for future, I'll not have that expense now itself.
No, here there's what do you mean by lock for futures? So now what you do here, you buy the asset today.
Yeah.
Whatever the underlying today, and keep it until September. Here you wait and buy in September.
Yeah. So if I buy the asset now itself, my whatever cash flow is for today.
Yes, in a way, yes.
Yeah, it's still September.
You have to pay cash today and get the asset. Okay.
So till September, it's 3 months. For that 3 months, whatever interest or whatever that I could gain from that cash is going out of my equation.
Yes. If you buy it today, you forgone your interest for 3 months period. Okay, that's true. So to avoid that, you go for this second one, not for the first one.
Yeah.
Okay. No, I'm asking without waiting on September, why do you buy it today? Okay, if I give you these two options, which one you select?
So the price is low, it's cheaper today, so you can buy, and if you have the capacity to store, then you can buy and store.
If you have the capacity to store, you can buy and store it. Okay, even if you have the capacity, you can wait until September if you want. Is there anything else that just because of you have the capacity, will you buy it today and keep it until September?
I mean, it should be less
So-
costlier than the price difference in. I mean, it should be less costlier to store, right? Than like buying paying higher price in September.
Why do you say paying high September, high price in September?
Because you're expecting it to go up, right?
Why do you expect prices to go up?
I mean,
Can it go down?
yeah, it could. Yeah, I see what you're saying. Yeah, makes sense.
So what is the main reason between these two choices? Which one you select?
So it is purely price expectation.
You're uncertain on the
Mostly,
price.
yes. Mostly it's the price expectation. If you think price will go up by September, you don't want to wait until September and buy it. You buy it today and keep it. Correct? If you think price will go up in the future by September, you will buy today and keep it. That's what happened in one of the Sri Lankan market these days. What's that? Even though it's difficult to do that now. What is that market? People are wanting to buy.
The gold.
Gold, maybe. Gold may be because of some other reasons as well. But purely based on the price expectation?
So that is oil.
No. Not everybody. Most of the people want to buy oil today. I mean, even general public is not allowed that. Dollars, yes. Importers, they are if they are allowed, they will buy it today. Why?
Because it's going to go.
That's what everybody thinks.
Yeah.
So likewise, whatever this underlying asset, if you think price will increase in the future, you don't wait until that time, you buy it today. That's the first factor. What do you think about the price in the future? Market expectation or your expectation on the price of the underlying asset in future. Then the second one, say, assume you forecast this price can go up to 401. Okay. You think today the market price is 400. By September, market price would be 401. And the 3-month interest rate is, say, 6%. Three-month interest rate is 6%. Now what do you do? Now what's your choice?
Deposit today and buy at future.
You keep your money today, $400, deposit at 6% until September. Why? What would be the value of this 400 rupees in 6 months? Sorry, in 3 months? 1.02 into 400. What do you get? I just assume like 3360. So that's why I divide this 6% by, oh, sorry, 3 months. We have to divide it by 4. One, 5. What is the amount that you get? If you invest 400 rupees at 6% for a 3-month period, how much will you get?
401.5.
401 point.
For 3 months, 6%. I take it as annual.
Yes, 6%. This is annual. Yes, definitely. This is 6% annual.
For 3 months,
406.
406. 1.015 into 400. You get 406.
but you are not keeping for a whole year, no, sir?
No, this for 3 months.
6% plus divided by 4, no? We arrived at 0.15.
That's how we get this one, yes. 6% divided by 4. 6% means 0.06. When we divide it by 4 for 3 months, interest rate is 1.5%. That means 0.015. That's why I write it like this. Into 400, you get 406. So
Yes,
we have your basics.
Correct. No, correct. I calculated something else.
We will keep that one as well. Okay, now you get 406 after 3 months. The price expectation is 401. Which one you select? Whether you buy it today or wait until September. You wait until September because you can earn 6 rupees. You lose only 1 rupees. The net gain is 5 rupees. If you are a rational person and you have you can expect this or you can predict this price fairly and it's accurate, you won't buy it today. So if your expectation on price increase should be more than 6% per annum if you are to buy it today. If it is less than that, you can postpone it until September to buy. So this interest component, yes, this is something important in this context. Okay, the third option, we have another third option. You don't buy today, you don't wait, but you buy a forward or a future. That means you enter into agreement today fixing the future price. So the delivery would be September definitely on this futures contract. Delivery would be September because you need that in September. Okay. Can someone tell what would be the maximum price that you agree? What would be the maximum price that you agree? Okay, for make it simple, assume there's no any storage cost or anything like that. You can buy it and it's a very small thing. You can keep it your home even. No storage cost or nothing. What is the maximum price that you would pay through a futures? That means or a forward. You agree a price today. What would be that maximum price?
400,
400,
406.
406. Why?
The future interest rate is
If you keep that 400 rupees for 3 months at 6% current market rate, you get 406. So if you keep buy it today and keep it until future date, you should be able to get that 406. Same thing. You keep it, buy it today, you forego on 6% interest, keep it 3 months, then you should be able to get 6 rupees. That's the maximum that you can get. So the seller of the forward contract should get that 6% gain. As a buyer, you are not ready to pay more than that. That's the exact logic behind pricing futures. So whatever the cost, you add that cost to the spot price, and there may be benefits as well. So this interest is a cost. You buy it today and keep it until 3 months. It's a cost. You forego on your capital, you forego on your interest, so it's a cost. That's why we add that interest cost. That's why you agree to pay 106 maximum, even to buy on futures or forward basis. So we add that all cost. Assume there's a something like a coupon payment or whatever benefit during this lifetime. You deduct those benefits. That is the concept. Is it clear?
Can you elaborate the seller side again, Mr. Shanta?
Yes. If the seller agrees to deliver this in 3 months, what he is foregoing? He is foregoing in what? If he sold it at 400 today, during 3 months, next 3 months, he could have earned this
6%.
6%, this 6 rupees.
Yeah.
Correct?
Yeah,
So,
because he has cash.
He has cash. So he foregone that. He doesn't want to do that.
Yeah.
He keep the asset. He doesn't get the cash to get cash today. He has to keep it for 3 months and foregone that interest. He should be compensated for that. What is that compensation? 406. So therefore, seller would ask at least 406 or more. Clear?
Because the buyer anyway can get the minimum of 6, no?
Yes, buyer without buying it, investing that 400 rupees today, he can get 6% on cash. The same thing is foregone by the seller. If you sold it today, you get 400 and invest it in the at 6% for 3 months, you get 406 after 3 months. But just by postponing that for a 3-month period, you foregone your 6 rupee interest income as a seller. So you need that to be compensated by the buyer or more than that. So therefore, at least seller will ask for 406 at least. He is happy if you can pay more than that. But on the other hand, from buyer's side, By postponing it without buying today, by postponing it for another 3 months, maximum gain he can get is 6. So therefore, he is not going to pay more than 6. He is happy to buy at lower price, less than 406. So they are ultimately equilibrium will be at 406.
So even though he might expect the price to go up, he's not ready to buy more than. I mean,
Who expect price to go up?
The buyer.
Yes.
So you said that.
No. Say okay. Let me put it like this. Spot price is 400.
Yeah.
And if you keep that, you get 406. Your price expectation is 410. What do you do?
So wouldn't it be like commercially sensible to purchase something like 408, block the price at 408?
Yes, but there's a risk. This is your just a forecast projection. It may be realized or not. But what is your cost of funding? It's just 406.
Yeah. So, but like that wouldn't be the maximum. He won't be capped at 406, right?
406, yes. Buyer won't pay more than 406. Seller won't sell it less than 406. So the equilibrium will be at that level. That's the logic of the futures pricing.
So when you said that benefits has to be deducted, how does it work?
Say during that 3 months period, you can hire this whatever asset and earn a income. Okay. If you don't buy it today, you forgone that income. That can be earned by the seller.
But that is possible for both the parties, right? Like if the buyer buys it today and hires it for 3 months.
That's what I'm telling. Okay. If the buyer buys it today, that rent income will be earned by the buyer.
Okay. Otherwise, it will be earned by the seller.
Otherwise, it will be earned by the seller. So without buying today, you postpone it for 3 months. You give up that rent income. So you deduct that because it's a cost for you. Sorry, it's a benefit that you could have received, but you passed it to the other party. Okay. So therefore you deduct it. That's the logic of this futures pricing. We'll move one by one. We'll add first only the cost, then benefits, and we'll do a few examples. So this is the idea behind this futures pricing. I think you got it correctly and understand the way that you answer to these questions and the questions that you ask. That's exactly what's happening.
Excuse me, Shanta.
Yes.
Generally in financial market, for any trading or buying and selling, we always look at the interest rate for that period on a general sense, no? To do the valuations even here for 3 months, whatever the interest rate that we arrive. So that is like a basis, is that so?
In a way, but I'm not sure what asking that. That depends on how do you factor that interest rate or the cost of funding. That depends on the product. Say when you buy a bond,
Yeah.
You pay cash today.
Yeah.
You have a future cash flows.
Yeah.
So depending on what is your required rate of return, you discount the future cash flows at your required rate of return to decide the price today.
Exactly.
So that's you are discounting. But here what we do,
yeah,
we are moving forward.
Moving forward, yeah. So either way, we are arriving at that return rate for that period,
Yes.
no?
Yes. We consider that because either you earn something or you forgone some interest income.
What I just observe is in all financial terms, even in futures, the primary basis is that from that only we move forward.
Yes.
Either way, you know?
Yes. Whether we go forward or we go backward, or that means from future date to today, that means discounting or calculating present value, future value, we consider the interest rate. That's why at the very beginning we learn those concepts, present value and future value. That's the fundamentals, basics. Yes.
Thank you.
So shall I move forward? Any questions? So as we discussed, when you buy something, you forgo interest.
Sorry, no doubt.
Sorry?
Sir, that 410, we do not consider that 410 because it
No,
is
we don't consider. We don't consider this.
because it is only speculation. No?
Yes, this is a speculation.
Okay.
And even say, even you are sure that price would be 410 after 3 months. What would be the price then today? If you get it for sure 410, what when the interest rate is 6%, what would be the price today?
So it will be more than 400, right?
It should be for more than 400. What you have to do, discount this 410 at 6% for a 3-month period. Got it?
Okay.
That's how market works. As one of you asked, your return interest matters. That's why, say, in any case, say when the spot rate is 400, interest is 6%, futures is trading at 410, what does it mean? Spot rate is 400, interest rate is 6%, futures is trading at 410. What does it mean?
Interest rate could go up.
Sorry?
Interest rate possibilities that rate could go up.
Interest rate?
Could go up.
No.
There's something other than the interest rate that is at play, right?
Maybe. So if you think that way, say there may be some other cost or something like that.
Yeah.
Assume we factor all those things. Assume, as I mentioned here, other than interest, there's nothing, no cost. So when I do this, I assume that no cost other than interest. You can keep it at your home, or there's no way that you can earn anything on that. Nothing other than that. When the spot rate is 400, interest rate is 6%, futures is trading at 410. What do you get? There's an arbitrage opportunity. In this environment, futures should not be more than 406. Now it is trading at 410. That means there is an arbitrage opportunity. You can sell the futures, get the funds, buy the asset,
deposit
keep
for
it. You sell the futures, get the funds, buy the asset, keep it, deliver it at the end, you will gain 4 rupees. So we'll come to that. However, whenever there's a difference between this implied rate and market rate, that means there's an arbitrage opportunity. Something is wrong. Either spot price does not reflect. That's what I ask. If you are sure that 410 that you are going to get at the 3 months period, now the spot price should be more than 400. But if it is not the case, spot price is 400. You are sure that you are getting 410 in the future, something wrong. Either interest rate is not correct, either futures is not correct, either spot is not correct. We don't mind whatever. We do the arbitrage trade and get the benefit. So we'll come to that. Forget about that part. However, the basic concept is this. You have to think about, if you buy the asset today, what would be the cost of buying that? What are the foregone other interest income or whatever the foregone income as a cost? Storage cost, maybe insurance cost, things like that, or the benefits that you could have received. So consider the net benefit, net cost, and add it onto the spot price to derive the futures price. So in the very first few examples, we are going to discuss only the cost, not the benefits. We assume no benefits, we have only cost. So buying the asset now has some cost. If you buy that assets, definitely you forgone your interest income. If you keep that cash, you can invest it and get a interest income. But instead you buy the asset today, then you forgone that interest. So therefore we have to add that interest cost. Not only that, there may be storage cost depending on the underlying asset that you buy. Depending on the underlying asset that you buy, there can be storage cost, or maybe you may have to insure that. Say you buy oil and put it into a warehouse. What are the risks? Somehow there can be a fire or something that destroys the whole bulk of oil. So there's a risk. To mitigate that risk, what do? You take an insurance. So then you have to pay the insurance cost. Something like that. So depending on the underlying asset, there may be, other than interest cost, there can be other costs. It may be storage or insurance, maybe paying licensing fee or something like that. So in simple terms, we consider all those costs. So as I explained earlier, the result is that anyone wanting to deliver in the asset in September, he is willing to pay the higher price because he can earn interest and he is not going to incur those costs. So therefore, he is willing to pay more than the spot price to buy it in the future instead of buying it today. Is it clear? The party who wants to buy the asset and required it on a future date is willing to pay a slightly higher price than the spot price, or it may be slightly or substantially high, depending, however, higher price than the spot price, because he can earn an interest and he can save his cost of storage or insurance or any other cost. So buyer is willing to pay high price. The same is true for the seller. he needs at least that costs and the foregone interest. The seller needs at least the cost and the interest foregone by the seller, the cost incurred and the interest foregone by the seller. So the seller will demand at least that or more than that. So as I explained earlier, or we discussed earlier, they'll come to an equilibrium at that rate. So this is what it's, yes.
So you say that there's going to be an equilibrium there, right? So the seller would demand the foregone interest and his cost. The buyer would only pay that amount similarly on the other way, right?
Yes.
Yeah, but then where's the economic benefit? Like he'll be like, for the both the parties, it'll be null, right? I mean,
yes.
So
that's right. That's right. By at the time of, that's a good point. At the time of pricing the futures contract or the forward contract, the basic principle is neither party gain nor loss. It's fair for both parties. Otherwise, one party is gaining, one party is losing. Okay. Assume, okay, forget about futures and everything. You are going to buy a bond from the secondary market. So you agreed at the yield of say 6%.
Okay.
Why the seller is selling at 6%? Is there a benefit for whether he is gaining or losing at that price?
Yeah. So the same case price there, but that is it because there are expectations for
their expectations and things
other than
the whether you sell or buy, that depends on your expectation. But to do that, you need a minimum or the maximum price that you are willing to pay or that you are willing to receive.
Okay. Thank you, sir.
Just by entering into a futures contract, by buying future, at that point you don't get anything.
You don't make a profit.
You will make a profit or loss depending on the subsequent price movement.
Okay. How it turns out. Okay.
So seller also wants the same thing. So based on that concept and that we call no arbitrage, neither party gain or lose, the model call it cost of carry. I'm pretty sure those who have done A levels or have studied, I don't know, commerce or business studies side, you have learned this model. True? Cost of carry. I haven't done this when I do A levels or even at the university level, but I have heard my friends, those who are doing commerce stream at that time, this is a big model for them. They are always talking about, oh, we have this cost of carry model. So I'm pretty sure you have learned this at some point of those who have done A levels and if you have done degrees in that side, in finance or commerce or that field. I'm pretty sure. Others, yes, those who have done bio, mathematics, they might have not learned this. So simply, the cost of carry is, what does it mean? If you buy the asset today, what is the financing cost? What other costs that you incur? Then what is your total cost of buying and carrying that into the future? That's the simple concept. Based on that concept, we calculate the futures price. But as I mentioned earlier, not only cost, there can be benefits as well. If you buy it, you may get some benefits. If it is a bond, you get coupons. If it is a share, there may be dividends. Some of these benefits may be in cash form, financial terms, but some of them may be like reputation, things like that. But that sort of benefits, intangible benefits, even those things will be priced into futures. However, the way that you can quantify it, it's like in a firm, there may be a asset called goodwill. How do you calculate it? How do you derive that? Same thing will be there in benefits. It's not like dividend or coupon income or rent income that you get in cash form, but there can be other benefits. All those will be factored here. However, and the thing is, once you get the benefits and the costs, we net them together. So therefore, the model is indeed, it's the net cost of carrying the position. That's the model. So the fair value or the arbitrage free value of a futures would be cash price, what is the current market price, and cost of carry based on net cost of carry. This is the principle behind pricing futures contract. The same principle is applied in pricing FX forward. So as we discussed, from economic terms, whether it's a future or forward, there's no difference. The way we trade it and organize the market is the difference, but basic economics are the same. Either you buy something on a future date or either you sell something on a future date at a pre-agreed price. So that price can't be different from futures and forwards. That should be the same, but practically, due to the nature of this margin and things like that, there can be a slight difference in practically, but theoretically there cannot be any difference between a futures price and a forward price on the same underlying asset for the same maturity. So both futures and price forward should be priced using this concept. Clear? Any question?
Sir, that in case of coupon interest and coupons benefits, it is only applicable to the financial asset for the others.
Yes. Depending on the assets, whether you get dividends, whether you get coupons, whether you get rent income, whatever it is, all the benefits and all the costs depends on the asset. So some of the asset there may not be storage cost, but there may be insurance cost.
But some assets can have only the cost, not the benefit.
Some assets only the cost, no benefits. Yes, true. Some assets only the finance cost, no any other cost, no any other benefits. But generally this is the model. If it is 0, you put 0. Then it doesn't matter. It works. Depending on the asset, the components will be different. Applicable components will be different. Is it clear? Okay. I'm just talking about the general model and giving examples. These dividend yields, coupons, and storage, insurance are example, but financing cost definitely will be there. So we'll do an example. Again, the cash price is 1,250 sterling pound. Interest rate is 6%. No any other cost, nothing. What would be the fair value of a futures contract expires in 90 days? The today cash price or the spot price is, remember this cash price means if you do it in the cash market, that means not the derivative market, cash market. You outright purchase or sell it. The price is 1,250. Interest rate for that applicable period is 6% per annum. What would be the fair value of a futures contract? What do we have to do? calculate the interest for a 90-day period at 6%, 4,250. Add that interest cost to this cash price to derive the futures price. Clear? We calculate the interest cost and add it to the cash price. So the cash price is 1,250. Interest cost, just forget about this rate. Interest cost is 1,250 into 0.06. This is the interest rate. What is this? Number of days into the future, because it's a 90-day futures contract, and 365. What's the reason that I use 365 here? Can someone explain why did I use 365?
For annum rate.
Annum rate. Okay. Why did I use specifically select 365? Oh, can it be 360 or 364?
This is in pounds.
This is in pound, exactly. This is in pounds. We discuss for sterling pound money market, we use 365. If it was in dollars, 360. So remember that. So when you calculate, the interest comes as 18.49. Therefore, the futures or the fair value of the futures contract is 1,250 plus 18.49, 1,268.49. This is the futures price. So if you want to buy this underlying asset with 90-day expiry, you would pay 1,268.49. If you want to sell, you need 1,268.4. Clear? Any question? Any question? If not, we'll move into the other example. Here, I have added a storage cost. To make it simple, storage cost is given as 0.05% per annum. So it's almost like interest rate. So you incur it throughout the period, and it is not you pay storage cost upfront or at the end. If you pay it upfront, the story would be slightly different. Can you work out? Remember again, still the currency is sterling and it's for 45 days. Now what you have to do, you have to calculate the interest cost and the storage cost. So the cash price is 750, interest cost 750 into 0.03 because 3% and for 45 days. You get 2.77. Storage cost, again, since it's given as a percentage per annum, we consider it as like paying interest. So do the same calculation, we get 0.46. And therefore, fair value would be 750 plus 2.77 plus 0.46. 753.23. Is it clear? Any question? Any questions? Okay, if you don't have any questions, I'll change this example slightly. Instead of storage cost, assume you pay £1 at the beginning of the period. So whenever you store it, you have to pay this £1 for a 3-month period. Now what would be the futures price? Can someone answer?
$753.77.
753.77. How did you get that? That's the important. 753.77. Can you explain how did you get it?
750 plus whatever the interest for 3 months. Plus
that means
£1
same 2.77.
Yes, and plus 1 for storage cost. Plus 750.
Okay, is it correct?
The $1 is for per annum. The £1.
No. £1 is for the 3-month period. No, sorry, whatever, this 45-day period. You pay it today at the beginning.
So that we have to find out the future value for that, I think.
Yes.
$1.
Because you incur cost today. This is a cost for you today at t equals 0. Today you pay $1 to someone. That means it's like your cost or the cash price is 751 instead of 750, isn't it? Or you can forget about these 750 cash price. Your interest foregone on that is 3%. At 3%, you can calculate this 2.77. But you pay $1 for storage cost. You pay it today. For that, don't you give up some interest for a 3-month period? So therefore, we have to calculate the future value of this $1. Add it. It's like calculating the interest on 751 at 3%. Then it should be more than 753.77 because you just add $1 here. It would be more than that. Is it clear?
Yes, sir.
You have to think about time value. You can add just $1 if you pay this at the, sorry, not $1, yeah, £1 if you pay it at the end. You store it for 45 days. At the end, when you get it out from the storage, you pay £1. Then you can simply add that one. Now, but the thing is, now you pay it in advance. Then you forgone interest for that £1 as well for a 45 days. Therefore, you have to add that one as well. The price would be slightly higher than 753.77. Clear? Is it clear?
Yes, sir.
Okay, shall I move forward then? We'll include whenever we have any other dividends or any benefits. This is just say in the index future. If you do an index future to buy the index, you have to pay the capital and you forgone interest, but the index may pay you the dividends. Then you have to deduct it as considering benefits. So we'll go. These are examples with some benefits, not only costs, with some benefits. And again, even the benefits are given something like a interest rate 2.25% per annum. So we do the same calculation as we did in the previous example for storage cost. So this is the market price, current price. Interest rate is 4.55. Dividend yield is 2.25. We need a future with a expiry of 182 days. So this is the summary. Cash index is at 1,265. Interest rate on dollars 4.55. Index dividend yield is 2.25. Then what is the fair value of the futures? 482 days future. Interest cost 1,265 into the interest rate into day count fraction. So remember, note that here I have used 360. Why? This is in dollars, US interest rate. So the dollar convention is to use 360 days. So this is the interest cost. What is your dividend income throughout that 182-day period on this index value at 2.25% rate for 182 days? This is the dividend income. So this is a benefit. We take the cash price and deduct cost and minus benefits. Clear?
So we can take the net of the interest also.
Exactly. Yes, because both these are given as like two interest rates. This is borrowing cost, this is lending cost. What you can do, just take the difference, use it. You will get, still you should get the same figure. You can do that. I just did it to explain the difference, costs and the benefits. So indeed you have a, whether it's a net cost or net benefit here. In this example, are you getting a net cost or a net benefit?
Net cost.
It's a net cost because your interest rate cost is at a higher rate than the benefit rate. So the difference is 2.3%. So your net cost is 2.3%. If you calculate 1,265 into 2.3% into 182 divided by 360 plus 1,265, you should get 1,279.71. Clear? Any question? Is it clear?
Small thing, Ms. Nishant, I'm not sure whether the question is directly related to what we are studying. Here, if you can go back to the previous slide, it's an index, no?
Yes.
Cash, it's an index, no? Similar to like AWPLR and so forth, no? Not AWPLR. Yeah, SPI or something, no?
SPI or something like that.
Yeah.
Yes.
So in that case, for those also, there is a yield, dividend yield.
So yes, because if you buy that index, that means you buy the whole stock market in that proportionate. When the companies pay dividends, that's the yield that you get through that index.
Okay. Because the dividends will have an effect to the index, no? Dividends paid by the companies will have an effect.
Yes. Dividend will have an impact on the company share price. That will have an impact on
in the market.
In the market. And as an investor, you get that cash flow.
Yeah.
So,
also, is there any rationale to for this naming as fair price, fair value? Is it something like dollar value? Is it a name? Is it just a name?
No,
or is it rational?
No. It's a rational because it's fair for both parties. That should be the fair price. None of the buyer or the seller gets any benefit.
Oh yeah. On a basic, without considering the market risk or whatever, on a basic understanding, that will be the fair price, no?
No. Market risk comes after, once you enter into the transaction, after the transaction. Depending on your position, you take the risk. But at the time of entering into the transaction, this price should be fair by both parties.
Okay.
There shouldn't be any advantage to one party and disadvantage to the other party. If it is the case, the party who get that disadvantage won't agree to this trade, isn't it? It's same like that bond. When you ask 6%, if the seller wants 5.9, there won't be any trade. Either you have to go to 5.9 or the seller has to come to 6%. Or maybe in between that, 5.995, something like that. So that's the fair price there.
Okay. So on top of it only, we might do a negotiation to arrive at a specific, agree at a specific rate, no?
Yes. But once you do a trade, that's the fair price. You may negotiate for whatever it is, and indeed fair price is the price that you get, but yes, no, sorry, once you do the trade, it would become market price, but everything would be adjusted for that. Then it become fair price. But generally the fair price comes through this model. If the market price deviates from this fair price, something is going in the market.
Okay.
Either interest rate or the spot price, something.
Yeah, based on that risk or benefit only we just trade, no?
And the market expectation. If you think the spot price will increase in the future, there will be more buyers on the futures. Then the demand for futures will increase. Then the futures price will increase. When the futures price goes up, to make it equilibrium, there should be changes in the interest rates and others. Otherwise, there will be an arbitrage opportunity. That's why we say this is the fair price. But other thing is, practically in the market, it's not one single interest rate prevailing in the market. Borrower's interest rate and the lender's interest rate is two different things. All those matters we'll discuss that towards the end when we discuss arbitrage. Is it clear now? Why do we call this fair?
Yeah, that was clear.
The one okay. I'll ask one question. Now all these examples we saw, futures price is higher than the spot price. Clear? Is it true?
Yeah, that's due to the interest, right?
Yes. Not only due to interest. That's what. Okay. Now try this one. Interest rate is 2.25. Index dividend yield is 4.55. Calculate the fair price of the futures for 182 and let me know.
Yeah, so it will be lesser than the cash price, right?
What's the answer?
1,250 is
1250.29.
1
250.
1 2 5 0
0.29.
0.49. Is it correct? Others, did you get the same answer?
Yes, sir. You just add 14 and deduct 29, right? Instead.
Sorry?
You add the 14 and deduct 29, right? It's the same calculation, right?
Yes. So instead of interest cost, this is the, you should get same numbers. This is the dividend and this is interest. So deduct this, add this. Same thing should be, but only thing is what I wanted to highlight is you get a lower number than the spot rate. Clear? Is it clear? Futures price is lower than the spot price. Is it clear?
When you see a lower futures price than the cash price in the market, that would be the reason always, or is it?
Okay, what is the reason behind this? That's what I'm asking. Now, why you get a futures price which is less than spot price? Why?
Because it's beneficial to go for a future than doing a cash transaction due to the dividend impact.
Yes, the thing is, in summary, your benefits are higher than your costs. Your benefits are higher than your costs. So therefore, futures price is lower than spot price. So that's why we are telling it's not about the future. What would be the spot price in future? In the future date, the spot price may be 1,300 or something like that. We never know. But now the current relationship, 1,265 and 1,250, this relationship depends on whether you get more benefits or more cost. Clear? Is it clear? If the costs are higher than the benefits, then the forward rate would be more than, greater than spot. If you get more benefits than the cost, then futures price is less than the spot price. So can you remember we saw the same relationship, same sort of relationship in FX forwards? I mentioned that FX forward is it's a forward contract. We use the same concept to price. Indeed, if you want to price up futures in FX, we use the same thing, same formula that we used there.
But there are no costs of carry, right? Is it?
Why not? Why not? That's the thing.
Yeah.
What is the forward rate equation? For simplicity, I just put R without any day count convention. Is it correct, this equation? Is it correct? This equation, is it correct? So you need to put that day count convention adjustment here. I didn't put it. Assume for a 1 year period, then this is correct. What is RC?
It is counter currency.
Counter currency. Is that the counter currency?
Interest rate of counter currency.
What is RB?
Interest rate of the base currency.
What is S?
Spot rate.
Spot rate. Is it a direct quote or indirect quote? So, however, it should be the price of a base currency in terms of counter currency, isn't it? This should be the price of a price of 1 unit of base currency in terms of counter currency. Now, in this forward contract, when you buy one currency in future and sell the other currency in future or a forward, what is cost, what is benefit? Say USD LKR. You want to buy dollar forward. What is cost? What is benefit?
Your cost would be the USD interest rate foregone, and the benefit is rupee interest rate. I mean interest.
Interest. So doesn't it capture it here?
Yeah, makes sense. Yeah.
So the difference here is both are interest. And instead of just like taking the difference like here, we use this discount in. If you can remember, I mentioned that the forward is very we can approximate by taking the difference of this interest rate. F minus S we can approximate by S times RC minus RB. This is just an approximation. So that goes here. Whatever our addition to the spot price is, it is this interest rate difference. But the same concept in a different way, because both are involved in currency forms. The equation appears in a different manner, but the concepts are the same. Clear? So even in this equation, benefits and cost, this is also a cost of carry model. If you want to buy dollar forward, you forgone interest on dollars, you get the benefit on rupees. So it is factored in this equation. So there's no difference in this model. So that's what I wanted to show you, the similarity in our FX forward pricing equation and the futures pricing model. Still we use the same concept. And the other thing is, again, even here you can remember, depending on the relationship between RC and RB, that means the benefit and cost, whether future rate is higher than the spot or futures, or the forward rate is less than spot, varies. Can you remember in here, if RC is higher than RB, forward is higher than spot. But if RC is lower than the RB, forward is less than the spot, almost like in this instance. Now try this one. Okay, do you expect a higher forward price or a lower forward price?
Higher one, sir.
Higher one. Still the interest rate is higher than the dividend yield. So, but the difference is small. So therefore you expect slightly high price in the forward. So cash index is 5,250, interest rate 3.5, index dividend yield 2.6. So it's 491 days. The fair price is 5,261.78. Clear? Any question? Any question? If you have any questions, please clarify at this point. No. Okay, then we'll move into the relationship between futures and spot price. Depending on that relationship, if you can remember, in foreign exchange market, if the futures price is greater than spot price, we call it as a premium. Remember, foreign currency is trading at a premium. When the futures price is, or the base currency, you can say generally base currency is trading at a premium when the future is, or the forward price is higher than the spot price. On the other hand, when the forward rate is less than the spot price, we call it a discounted market. The foreign currency is trading at a discount. Similarly, in futures, we use two different words, contango market and backwardation market. Whenever the futures price is greater than spot price, futures price is greater than spot price, we call it a contango market. When it happens, when your net cost of carry is positive, that means your costs are higher than the benefits, or cost exceeds benefits. Then your net cost of carry is positive. Then your futures price is higher than spot price. We call it a contango market. Clear? So is it clear? What is a contango market? Like in FX, when I say the base currency is trading at a premium, you know the relationship between forward price and the spot price and the relationship between two interest rates. Likewise, whenever you hear that particular underlying asset is trading in a contango market in futures, you know that futures price is higher than the spot price. That because of costs are higher than the benefits. Clear? So this is a normal situation in most of the equity markets. Interest rates are higher than dividend yields. So therefore, there's a net cost of carry. That may vary from market to market. That means depending on the underlying asset. Then the other one, backwardation market. Whenever the futures price is less than the spot price, then we call it a backwardation market. When do we observe this sort of market? Is when you have more benefits than the cost. That means you have net benefits. Whenever you have net benefits, futures price is less than spot price, then we call it a backwardation market. So backwardation is mostly common in both bond and short-term interest rate, because especially bond are long-term. So your cash flows may be high compared to long-term interest rate, because long-term interest rates are low. And you do trades for short periods, 3 months, 6 months, or 1 year. So then the tendency is benefits are higher than the cost. So there can be a, you will observe a backwardation market.
So usually the long-term interest rates are high now?
Yes, generally that's the condition. So when the long-term interest are high, that means your coupon would be high. Your cash flows, that whatever you get, your benefits is higher than your funding cost. Clear?
Even that in the equity market, the risk is higher, why that return is low?
No, remember, here what it says, benefits. What are the benefits? Dividend yields. Dividend yields may be lower than the interest rates. But the return on equity, it's not only dividends. This dividend yield, it doesn't mean that only this is the only return. This is not return. We are not talking about the return on equity. We just talk about what you get as dividends. Clear? Is it clear?
But still it is low, no, rather.
Yes, dividend yields may be lower than the most of the time. Yes, that's what it says. Even in Sri Lankan market, there's no dividend yield.
But it should be, when you compare the risk, it should be higher, isn't it?
Not. That's what I mean. When you that's the other thing. You should not buy shares with the expectation to get dividends and give a dividend yield than the interest rate, because in shares, return is not only in the form of dividends.
Okay, sir.
What is the return on shares?
Capital gain.
Capital gain.
Market price.
That has to be factored. But in this instance, we cannot consider that part. Why? It will be reflected in the cash price. In the future date, whenever the expiry date, whatever the capital gains accrued on the share price will be reflected in the share price. It is not a benefit for you. You don't get it until you get the you complete the transaction, and that benefit is already priced into the share price itself. But dividend yield is not like that. It is an interim cash flows that you get as a benefit. That's why we have to consider this as a separate benefit.
We use example that we took that 365 because it is FTSE is in London.
365 we used because it's this is again index, FTSE 100 index. That's a London stock index. So we use 365 because of this sterling pound.
Okay, sir.
Mr. Nishant, if you don't mind, can you go over that backwardation on this? What it says is this is common for bond markets, no? They are the markets with the long-term interest and the short-term interest. The long-term interest is referred to the coupons, no? Is that so?
In a way, yes.
And what does this short-term rates refer to?
So, say what is the 3-month interest rate? Maybe it should be low. Okay, simple. You can understand this. Like, say, okay, how do you finance your bond holdings?
Cost of funding.
How do you finance it? I mean, cost of funding. Yes, there's a cost of funding. No.
So let's say I borrow money and invest.
You borrow money, but for how long?
Yeah. So
you don't borrow for 10-year and buy the 10-year government bond as a bank.
Yeah.
Especially.
Yeah.
You take deposits for 2-3 months, 1 year, maximum 1 year, sort of. Or even if you don't have that, you borrow from the call money market or through a repo, maybe overnight or maybe 1 week, something like that. You fund your long-term position through short-term funding.
Yeah.
That difference is your net carry.
Yeah.
So your cost of funding is small, benefits is high. That's your margin. So the same thing here. Because for say for a 10-year bond, if you enter into a 3-month futures contract, what is the interest rate that you are going to apply?
3 months interest rate.
3 months interest rate. But the coupon would be considered in a 10-year period.
Yeah.
So that benefit is higher than the short-term interest.
Funding cost.
Funding cost. So it will give you a net benefit. But this would happen especially when the yield curve is upward slope. If the yield curve is downward sloping, or it was like that previously, whatever the long-term bonds prevail in the market carries small coupon, then this may not be no longer valid. But generally, common case is upward sloping yield curve, and the long-term rates are higher than the short-term rates. So you get a net benefit. I think this is an example like that. The cash price of a bond is 110.50. Interest rate available on a 30-day deposits are 6% per annum, and the bond yield is 7% per annum. So what is the fair value of a 1 month future? So what again you do the same calculation. So I just net it here without calculating these two in different manner. Finance cost is 110.50. That's the cash price. This is the cost. This is the benefit, which just for a 30-day, I just divided by. Indeed, it should be 30 divided by 365, but I just would be better if you use it 30 divided by 365, but for simplicity I use it 1/12. The cost is minus because you get net benefit, so the fair value is less than the cash price. So this is in a backwardation market. Is it clear? There's another example. Even here you should get something lower than 104.30 because short-term rate is 3%, bond yield is 5%. So you get 103.95. Futures price is lower than the cash price. I think very straightforward now because we did few calculations. Do we have time? Okay. Then the next concept. Okay. Any question so far? Are you clear about what is a contango market and what is a backwardation market?
So in the backwardation market, how it happens?
Because your benefits are higher than the cost.
So why do you take that the benefits in long-term rate?
Because that's the bond yield, that's the return that you are going to get by investing it. Your benefit is the yield in the bond.
So that's what you explained in the bonds, how do
Yes.
you short-term something or long-term?
Similar to the equity dividends, no?
Equity dividends, yes. Even in that case, dividend was expressed as a percentage per annum. So it's like a yield. That's the yield that you are getting.
There the interest rate was higher. Here the interest rate is lesser than the that's a variation.
Yes, the short-term interest rate is higher than the dividend yield, but short-term interest is lower than the bond yields, long-term bond yields. If you take a short-term bond, this may be the other way around again, or maybe almost same. There may not be any benefits or cost. That can happen. That can go flat. Futures price may be same as spot. That can happen. If the benefits and the costs are equal, that's flat.
So are there any examples for backwardation like
So these are
negative
these are the examples. When you have
other than this?
other than this, that's what I use it as an example. In any case, if the dividend yield is higher than at any moment, dividend yield is higher than short-term funding cost, that can be one thing. And there may be other instruments in the market. Say if you take gold, oil, that depends.
So when there are negative interest rates, it is a positive.
So say when there's a negative interest rate, yes, it's a benefit. Then it will become a benefit.
Okay, sir.
So whatever the rates applicable, this concept won't change. Whatever the interest rate, whatever the benefits, you put them together, calculate the net cost. If net cost is positive, it's in the contango market. If the net cost is negative, you are in a backwardation market. Depending on the market condition, depending on the asset, interest rates, dividend yields, or the bond yields, or the other benefits. So the relationship will change. Even it is possible. One futures contract today trading in a contango market, in future it may be in the backwardation market. It's like, okay, good example. For example, until very recently, say 1 or 2 months back, dollar rupee forward, was it in a discounted basis or premium? Dollar at a premium or dollar was at a discount?
Premium. It was at discount, no?
Previously, maybe 6 months back, say 6 months back, it was in a premium. Now, in dollar rupee,
discount, no?
now it's at a discount. So that can happen. But these examples are general and very clear markets where you can see these things. Is it clear?
Okay, sir.
Okay. Okay, the convergence concept is, so now you know the deviation from the spot market, the futures price deviation from the spot market, either plus or negative, depends on the spot price. Okay, forget about spot price. No, benefits and costs. Whether you have more benefits than cost or more costs than benefits. And that cost and benefit amount will be depend on the time to maturity until time to expiry. If you do the same calculation, instead of 3 months or 6 months, what would happen? These figures may be bigger than this, isn't it? Just take, instead of 3, increase this to 4. This would be 0.7, isn't it? So therefore, when the time to maturity, remaining time to maturity increases, the deviations are high. But when it come closer to the expiry, what would happen? These benefits and costs would be, differences would be very small. So ultimately, on the expiry date, what would happen? On the expiry date, what would happen to the futures price?
Equal to 40.
It will be equal to the spot price. That is the concept called convergence. So until from the beginning until maturity, there will be a deviation, spot and for futures price deviation. But when it get closer to expiry, futures price converge towards the spot price. That is the concept here, convergence. So at the expiry, cost of carry is 0, benefits are 0. So therefore, spot equal to futures. And there cannot be any price difference. If you have a price difference in futures contract and spot on the same date, on the expiry date, what would happen?
Arbitrage.
There's again an arbitrage. One will buy one cheap one and sell the expensive one. Again, prices will get adjusted quickly and come to an equilibrium. In that also we can justify that on the expiry date, futures price should equal to the spot price.
So it has to be equal to the spot price in market, right?
Yes, yes.
So imagine like we do this contract 3 months before,
Mm-hmm.
right? So why would it like the having this contract wouldn't have impact on the market prices now? So why? I mean, we are writing a contract or we are purchasing a contract would not have an impact on the entire market now. So how does it like when we come close to this price is also specified now? So why should it?
That is your contracted price. Once you buy it, that's the contracted price.
Yeah.
It won't change it won't converge to the spot price. That is your contracted price. But in the market, with the time, price will adjust it and get closer to the spot price. But that's not the spot price prevail at the time that you entered into the transaction. That's the spot price prevail in the market on the expiry date.
Yeah. So on the expiry date, so we have say price of 100, right? Now should the market price also be 100 for that?
That's what it says. Future. What do you mean by market price? Whether the spot.
The same asset in the market, can we buy it at 100?
That's what spot price is 100. That's what future price comes to the spot price, whatever spot price.
Yeah.
Spot price means the market price on the expiry date. So whenever we say here,
I see. It's logical that when you like factor the carrying costs and interest, so it should technically come to that price, right? But what if like the interest or so the interest that was used was different to what actually happened in the market or something like that? Is there like
no, but when it comes to the expiry date here, whatever the interest, it doesn't matter because no time to maturity. Time T is 0. T is 0, and basically you don't have intraday interest rates.
No, I see. So the futures price that we have is fixed now.
What you have, that's what I'm trying to. So here you buy this.
Yeah. So the price that I decide
this is fixed. This is fixed.
Yeah.
But this won't change.
Right. That is not going to change. So what would change is the market price, right?
Market futures price.
Right.
In the market now we have two markets.
So with the buying and selling price of that market, the futures in the market would be similar to the spot price. Like
we have two markets. One is futures market on the same underlying. Other one is the spot market. Clear?
Yeah.
Okay. Now here what I'm saying, whatever the transaction you did it doesn't matter. It's fixed.
Yeah.
But what I am referring here, every day futures price changes means in the market this futures price.
That market futures and the market prices would
Market
come.
futures and market spot price changes. It may go up and down, no, whatever.
So
But
that,
there will be a difference between these two.
yeah.
That difference get narrower, and on the expiry date,
It will be the same.
this would be the same. Okay, sorry about that. Now only I realize that whenever I refer generally futures price, it doesn't mean that the contracted price. What is the market price?
Okay, thank you, sir.
Okay. Now it's clear, no?
Yeah, it's clear now.
Okay. Because this is maybe at a point of time, this is the fair price. This may be your contracted price. But next day, the market price might have changed, but your contracted price remain unchanged. We are talking here about the market price. Market price goes up and down. Even the future price goes up and down. Spot price goes up and down. There will be a difference. So say not only if market price changes, the spot basis, there can be changes in interest rates. Even the spot, without any change in the spot price, if interest rate changes, what would happen? Still the futures price changes. Is it clear? Because your benefits or costs, that will change depending on the interest rates and other benefit rates. So then the next concept is basis. I'll explain it quickly, but now you will start to confuse with the contango and backwardation market, because the way we define it here is basis is the difference between cash price minus futures price. Remember this, note that. Cash price, that means the spot price, whatever the spot price in the market and what is the futures price in the market. That difference is the basis. Now tell me, in a contango market, whether the basis is positive or negative.
It will be negative, right?
It should be negative. That's the thing. Okay, remember that properly. That's the point that you are get confused. Okay, because in the contango market, futures price is higher than the cash price. So, but in basis, since we define the basis as cash price minus futures price, the basis is negative. Basis is negative, then it's a contango market. What does it mean? Costs are higher than the benefits. On the other hand, basis is positive, the market is a backwardation, benefits are higher than the cost. Clear? That has to be clear, like what we discuss in FX forward, whether it's in a premium market or okay, this basis is like swap points. Can you remember we discussed swap points? If the swap point is positive, what does it mean? Is it a premium or a discount?
Premium, sir.
It's a premium. If it is a premium, forward rate is higher than the spot rate. If the forward rate is higher than the spot rate, interest rates of the base currency is
Lower
than the counter currency. The same relationship is here. So you can see the similarities, because economically futures and forwards are the same. In FX market forwards, we use some different notations and different words. In the when it comes to futures, it uses a different set of words. Is it clear now? Remember, basis is positive within a contango market or the backwardation market. Basis.
Shanta, is it possible to look at this with the slide number 16 example itself?
16.
Yeah, bond. No. Our PDF shows different slide number 32. Slide number 32.
Huh?
Slide number 32.
This one.
Yeah, based on this.
You are referring maybe page numbers, not the slide numbers.
Yeah, page.
Because two slides per page, no?
Yeah.
Page 16.
Yeah.
Okay. What you want me to explain?
Based on this example, if we look at that basis concept.
Okay. Now basis is equals cash minus futures. Correct? Cash price minus futures price. What's the cash price here of this bond?
104.30.
104.3. What's the futures price?
103.95.
103.95. So you get positive points.
Yeah.
Correct?
Yeah.
0.35. Correct. So basis is positive.
Yeah.
Then
Backward.
Backwardation market. Clear?
Yeah. Basis is reflected in the terms of positive and negative figures, no?
Yes. Basis can be positive or negative. If basis positive, it's a backwardation market. Basis negative, it's a contango market. But remember, positive basis does not mean futures is higher than the spot. That's the confusion comes. Yeah. When you say positive points, you tend to add it to the cash price and get to the futures. It's not because here the definition is other way around. But in FX, we define the sub points as futures forward trade minus spot. Then there was no confusion in that. When the points are positive, you add it. Then the forward rate is high. But here, it's other way around. Is it clear?
Yeah. Thank you.
So, with that, remember this equation as well. So, this is the cash price. This is the forward price, futures price. So, this is in a which market? Futures price is higher than the cash price. This is in a contango market, and the basis will get reduced with the time and converge to the spot. Clear? But this graph now only I realized it could have much better since. No, sorry, this is not. This is showing the price per barrel. No, this is correct. This is not the basis. Basis, yes, correct. So price per barrel, spot price is lower than the futures price. This difference is basis but negative. Then the basis changes. At the end, it equals to the spot. But now there's another trick. Oh, sorry. Another key here. Say this is, if you calculate the basis here, say base is -5, 42, 46. Sorry, it's around -1. Correct? In this point, at this point, basis is like, sorry, 42, 46. Basis is like -4. Correct? Because cash -4 futures. Basis is -4. That's why it's in a contango market. If you go here, what is the basis? It may be close to -2. Okay, now tell me what has happened to basis. Has it increased or decreased?
Increased.
Exactly. Now that's the other point. You get confusion. Here we have to think about the sign as well. -4 to -2. Is it increase or a decrease? Go back to grade 5, 6 or somewhere there. We had a concept called number line. 1, 2, 3, 4. -1, -2, -3, -4. Something like this. Remember? When we move this way, it is an increase or a decrease. One to two, is it an increase or a decrease? Increase. -4 to -3. Increase. So what has happened here? Basis has increased. Remember that one as well. Okay. So I'll stop with this. Think about it and remember this. Try to understand backwardation. What is the basis? Contango. What is the basis? Then with the convergence, what would happen to the basis? Whether basis is increasing or decreasing, that different in contango market and backwardation markets. Think about it, because in coming slides, we'll discuss about strengthening basis and weakening basis. That goes with whether basis is increasing or basis is decreasing. In number wise, it would again be like confusing in the backwardation market and the contango market. Just think about it before you come to the next class next week. We'll stop here. Any questions?
So page number 16, please. So page number 16, please.
Yes.
Page number 16,
Page
please.
page of the slide.
Slide 16.
Slide 16.
Okay, so slide 22 as well. Okay, sir, thanks.
Okay, thanks. Anything else? So if you don't have any questions, shall we stop here? Okay, thank
Sure,
you.
Thank you.
Thank you, sir. Yeah.
Thank you.
Was there any question
So
from
yes,
some?
in the case of basis, though the value is increasing, value is increasing, but the basis points
Gap
is
decreases.
increasing.
Yes.
Okay.
In the contango market, value increasing -4 to -2, true. But the gap in absolute terms, figure decreases and the gap decreases. That's what the question you had.
Yes, so that's so ultimately what we are saying is value is increasing in questions which you ask.
Yeah, no. Think about in a backwardation market, what would happen? That means in a backwardation market, there will be a line something like this. Now what would happen? What is the basis here? What is the basis here? What has happened to the basis? Has it increased or decreased?
They are decreasing.
They are decreasing.
When we compare with
But
that, it should be increased, no?
huh?
When we compare it like that, the other way around it should be, so that should be
So
increasing.
no, in this it's increasing, but in this basis decreasing. Got
So
it?
in the both markets, can we say
Because this is -4 to -2. But here may be +4 to +2. So in the backwardation market, when it gets closer to expiry, basis decreases, whereas in a contango market, when it gets closer to expiry, basis increases.
but we consider basis as a gap, no, sir?
Yes. No, but there's a particular definition.
Yes, okay.
Spot minus forward. Then it can
Okay.
be minus of as you think as a gap. Yes, gap decreases, gap narrows. But in terms of basis, it's slightly different.
Okay, sir. Okay, thank you.
In absolute terms, yes, absolute terms it shrinks, narrows. But with the sign, it's different. That's what I ask you to think about it.
Okay, sir. Thank you.
Okay.